So look, there's a lot of advantages to through fund portfolios. You get great expense ratios, so they don't cost a lot of money. You get great diversification. You have asset allocation, so you have different asset classes. There's a lot of things to love about three fund portfolios. What I wanted to talk about today was not that three fund portfolios are bad or anything like that. Really, I just wanted to talk about something that's been going on, because if you recently look at your three fund portfolio, you're really not doing that great. And that's what I wanted to talk about today. Now, if you're watching this, I'm sure you're probably just like a regular person, right? Maybe you're a teacher, maybe you work at marketing in a hotel, maybe you're a manager at a restaurant. There's a lot of normal people that invest in the stock market right now. Basically, three fund portfolios are for people who don't work in the industry probably, right? You're not a portfolio manager. Working for a hedge fund, you're probably not doing this full time in finance, right? That's probably not what you're doing. So you're in a three fund portfolio because it's easy. It's not complicated, right? You don't have to pay attention to it all the time. That's the great thing about three fund portfolios. But when I think about the market, here's kind of what I think about. I think of the market as like a barbecue, right? And it's always about your neighbor, because when it comes to the stock market, we're always kind of talking to the people around us and how they're doing, and that's kind of how we're gauging ourselves. So when you're at a barbecue, let's say your next door neighbor is having a birthday party, they invite you over and you're talking with him or her and all their friends, and he's suddenly talking about his portfolio, right? And he's saying, hey, I either did one of two things. I'm doing great. I'm up 10% right now. And what do? You think to yourself, well, he's up 10%. Maybe you compare yourself. Okay, I'm up 5%. Why is he doing better than me? Okay, what's he doing that I'm not? And this is that situation that always occurs where suddenly people see their neighbor doing a lot better than them in the stock market for whatever reason, and then they start chasing what they're doing. And what's happened recently, the past 2 years, it was growth stocks. People were making huge percentage gains in the stock market by investing in stocks that really didn't have much cash flow. And maybe these companies just shouldn't have been at the prices they were at, right? But what happens is, because of things like herding, following the crowd, right? Your neighbor is making more money than you. You go out and you start investing in things that are more money. And this is what happens. Three fund portfolios are good because they prevent you from usually doing something like that. The reason I'm really making this video is because I know that there's a lot of people who have three fund portfolios that might be talking to their neighbor, that might be talking to their friends, and their friends are more aggressive. They're investing just in the stock market, and you as a three fund portfolio owner, you probably have bonds in there, right? You have international stocks, you have stocks in the US, and you might be thinking to yourself, why am I down just as much as my friend who's only investing in the stock market? In other words, I'm supposed to have less risk because I have bonds in my portfolio. I shouldn't be down as much as them. But what's happening is you're pretty much down probably the same amount as these friends who are taking more risk. So what's going on? So what I want to do is I want to compare three different types of portfolios. So first is someone who has a three fund portfolio. What do? They have a total stock market index, or ETF. I'm using VTI in this. You could also have VTSAX, which is the equivalent of their index fund of this ETF. You could also have VXUS, which is the Vanguard Total International Stock ETF. The equivalent index fund of this one is VTIAX. And then you have BND, which is the bond ETF. So it's the Vanguard Total Bond ETF. Now VBTLX is the equivalent of that one, right? So maybe you invest in that. So you have a three fund portfolio with Vanguard ETFs. First off, okay, why do you have it? Well, if you just look at the expense ratios of these Vanguard ETFs, look, gross expense ratio 0.03% for VTI, VXUS 0.07%, and BND 0.03%. Extremely low expense ratios. You pay like nothing for these ETFs. That's why people own index funds or ETFs that have very low expense ratios. You're going to save a lot of money in fees. So going back to the portfolio, here's what I'm assuming. Okay, VTI, so the total stock market, US stock market, 50% of your money is in that. 30% is internationally in VXUS, and then the other 20% is in the bond ETF. So you have what's called an 80-20 portfolio, 80% in equities, 20% in bonds. And that 80% that's in equities, it's got both domestic and it's got the international component. Now what I'm doing is I'm saying, okay, well, what if we compare this to VOO or BND? So let's say a two-fund portfolio. What if you take out the international aspect of this? That's the first thing I want to take a look at. The other thing I want to do is say, what if you just invested in VOO, the S&P 500, which is a very popular ETF to invest in? You're getting exposure to the biggest 500 companies in the market, and a lot of people do that. They just like this one ETF, they just invest in that, and that's it. But that should have a lot more risk, of course, because you don't have the bonds in these other funds. So here we go, and we look at a back test, how these have performed recently. Okay, we have Portfolio 1, which is the 3-fund portfolio. So how's that done? $100,000. Let's say you invested 100 grand. That's worth $240,000 right now. That's a compound annual growth rate of 8.55%, which is good. Don't get me wrong. Everyone will be happy with that. I would be happy with an 8.55% rate of return over, let's say, a 10-year period, right? I'd be happy. The standard deviation is 11.21%. So that's how risky it is. The best year was up 23.63%. The worst year was down 16.32%. The max that was down, let's say from the peak to the trough or to the low part, is down 18.05%. Okay, so these are the things that I want to talk about here. Look at the second portfolio, okay? You still have bonds, but you don't have the international stocks. You just took out the international stocks. You have a two-fund portfolio, 80% in VTI, and then you have the other 20% in BND, in bonds. So $100,000 in that grows to $310,000, which is about $70,000 more than the other portfolio. So the portfolio that had international stocks has $70,000 less money. You had a compound annual growth rate of 11.2% instead of 8.55. Your standard deviation it's basically the same. I mean, 11.21 versus 11.30, call it the same. I mean, that's basically no change in standard deviation. They're both the same amount of risk. This is done better in the best year. It did less worse in the worst year. And it did about the same max drawdown, right? So what did you get with this? You actually got a better return for the same amount of risk. You get the same drawdown as the worst return, right? So risk-wise, you're not doing any better by having this 3-fund than the 2-fund portfolio. Why am I saying this? I'm not saying this to tell you that you should go out and buy a 2-fund portfolio. That is not what I'm going to say in this video. But I do want you to understand, because I think a lot of people, when they look back, they think to themselves, why did I not do as well as some other people that have been investing when I had this 3-fund portfolio that was invested in stocks and bonds, but other people are doing better than me? Now, of course, if you just have taken the bonds out and you only have the S&P 500, 100,000 grows to $386,000. That's a lot more than both of these, of course. 13% rate of return, but standard deviation, that's definitely higher, right? So you take more risk to get to this number, and maybe you don't want that risk, right? And then your max drawdown was almost 2 percentage points more in the worst drawdown, okay? And then these are the growths of these portfolios. And so interestingly, if we look at 2022, what happens? Well, so far this year, the first portfolio is actually down more than the second portfolio. So the international stocks have also been down more this year versus the one without international stocks. And the 3-fund portfolio is doing the exact same, basically the exact same as the S&P 500, right? You're not getting the defensive part of the bonds. They're not really working right now because interest rates are going up and not down, and there's just the interest rate environment for bonds is not looking good right now. And so these all are kind of combining into a thing where the protection that you have, that 20% in bonds, which should usually shield you from having just the same downturn in a recessionary period like we are right now, it hasn't done anything for you. It's not helped. I mean, it's helped a little bit, yeah, but the international stocks combined with the bonds, combined with the total international ETF, that 3-fund portfolio, has not done any better than just investing in the S&P 500, which you would think would not happen in a time when there's such a recessionary environment going on. You would think that this would be a more defensive portfolio, your 3-fund portfolio. So look, I don't want to dissuade people who have 3-fund portfolios. I think they're great. I just want you to know what's happening, why it's happening. So essentially, it's mostly based on international VXUS, the international part of your portfolio. This kind of green looking line is VXUS. This is going back until February of 2011. Look how much better VTI has done. Up 269% versus VXUS, which is international, only up 41%. And your bonds at certain points actually were outperforming the international equities in your portfolio all the way up until like 10 years into there, 8 years into this, right? So what I'm saying here is that the international part is really what's driving down the performance of three fund portfolios right now. You would think that it's the bonds, because bonds have that lag. They shouldn't basically grow as much as equities, but this is not what's happening. What's happening is both the bonds, of course, are holding your portfolio's performance down, but they're giving you, hopefully, diversification against some risk that you might be taking. But then that international part is just not working out very well. Last thing I want to talk about, international performance in stock markets, okay? There are times when the US stock market does a lot better than international stock markets, and there's a time where it doesn't. Look at these time periods where it did and did not. So every time this is up, it means international outperformed US stock markets, okay? In the 70s, up. So international outperforms. Then another part in the 70s, mid-70s, US outperforms. International outperforms. US outperforms. US outperforms. International outperforms, okay? We're in the 80s now, right? You get to the 90s, US. A little bit of international outperformance, then you have US, and then you have international performance in the early 90s. And this is the time when I kind of started getting into investing, and this is the time when you could see that if you looked back at the time period that you were in, you're like, why would I invest all my money in the US stock market? International has been doing amazing. Emerging markets were basically killing it at this time, and then developed markets were okay too. So that's where we were, and then now we're in this long period of time. I think it's the longest out of all of these where international stocks have underperformed the US. So if you're looking back and you're thinking, why is my three fund portfolio down right now, year to date? Why is it down as much as the general stock market? Well, it's really because your international ETF portion has not been doing well. Of course, also your domestic portion isn't doing that well either, and also bonds aren't helping either right now. So nothing's really working in a three fund portfolio right now at this point in time. Again though, this isn't going to last forever, and that's why people own three fund portfolios, because if you start owning a three fund portfolio at this point, suddenly your three fund portfolio is going to do a lot better than just a domestic portfolio with bonds, and that's why you own the three fund portfolio. I hope this kind of helps you understand what's going on. If you're a little bit like skeptical about what's going on in your three fund portfolio, maybe this helps, maybe it doesn't. If you just keep investing, you keep that three fund portfolio going, I would hope that at some point in time, international is gonna start doing well. I don't think it's gonna be any time in the next couple of years. Europe's not looking very good right now. International markets aren't doing so great, but I think it's gonna essentially happen at some point in time, not too distant future. So anyway, that's all I have for this video. Please, if you like this video, hit that like button, subscribe to see future videos like this, and watch another one of my videos coming up on the end screen right now. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.